SENSEONICS is setting up for a short squeeze. When exactly it'll happen, we are not sure, but based on what we see, there's a short squeeze coming. What's up, guys? Welcome back to the channel. My name is John, and this is John Paul Investing. Today, we're going to talk about the SENSEONICS short squeeze brewing, what the numbers actually mean, and the significance or indication to a short squeeze that they give. We have two things to look at. We're going to be looking at short interest compared to the float, and we're also going to be looking at shares short compared to average traded volume, and this gives you the days to cover in a stock. Before we get started, all I ask from you guys is to hit that like and subscribe button. This way you get notified when I make videos just like this one, and it's a great way for you to support the channel. If you would like to know exactly when I buy or sell any stocks, this includes both stocks and options, go ahead and check out the link in the description to the Patreon group. There is a limited number of spots available, and once they sell out, I do not open any more seats. So I highly recommend you guys check out the link in the description. And do not forget to claim your 2 free stocks. All you have to do is click on that link, open an account with WeBull, and deposit $100. You will then get your 2 free stocks, which you can then sell and do whatever you want with that money. It is risk-free money, guys, so I also highly recommend you check out that link as well. The shares short in this report in the middle of April was around 68 million shares short, or 67.5 to be a little bit more precise, with a days to cover ratio of around 1.6 at the time of this report. As we can see on the right, it was $2.10 on this report date, and right now SENSEONICS is trading at $2.12. So in the past 15 days, SENSEONICS really hasn't moved much at all. Real quick, SENSEONICS actually did release a date for their first quarter earnings for this year, 2021. They will release these figures at market close on Thursday, May 13th, 2021. The conference call will be at 4:30 p.m. Eastern Standard Time that day. So if you guys are wanting to look for this, your broker should have a link for you guys to join. You could also have a link to the webcast available on their website at sensonics.com. So looking back at the short interest and days to cover, why are these relevant? What is important, and how is this indicative of a short squeeze? Well, to understand why exactly this contributes to a short squeeze, you first have to understand what's happening when you are shorting a stock. When you are shorting a stock, you are essentially borrowing a stock from the broker. You are promising to repay the broker the shares that you borrowed. So if you borrow 100 shares, you have to give them back 100 shares. Now, the difference with shorting a stock is you are essentially borrowing an asset that fluctuates in price. Let's say you borrowed 100 shares of SENSEONICS at $5. You immediately sold it. So if you would have sold it for $500, today you could buy back the same shares for around $212, meaning that you keep the close to $300 difference. The catch, though, is that whenever you hold shares short, you have to pay interest on it. And the more shares that are essentially short or being lent out, the more the brokers will start to ask for an interest because the risk on these short positions does go up. And in order to cover your short positions, you essentially have to buy your stock back, meaning that if you close it, you are actually a buyer just like the rest of the market. This adds buying pressure, you dry up the order book of low bids, and the price starts to hike up. But two other indicators we can use is the shares compared to the float shares, which is the shares that are actively in the market circulating. And the second indicator we can use is the days to cover ratio, which is the number of shares short divided by the average traded volume. For example, let's say there's 10,000 shares of SENSEONICS, but 200 of these shares are held by company officers. In this case, the public float is actually the 9,800 shares not being held tightly by, company officers or anywhere else where essentially the shares are locked up and otherwise untouched. Out of the 9,800 remaining shares, let's say 100 shares of those are actually short. The short interest ratio is those 100 shares divided by the 9,800 actually circulated and not the full 10,000 shares. This gives us a short interest ratio of approximately 1%. So today's SENSEONICS float is around 281 million, meaning the shares short against the entire float, or 67 million divided by the 281 million shares of float. This gives us around a 24% short interest on SENSEONICS. Now, there are websites like highshortinterest.com which give you the numbers for you, but it's good to know exactly how they calculate this number. So this way you can cross-reference and figure out what the number actually is. According to high short interest, it's around 20%. However, the discrepancy is in the shares float that they're calculating compared to the shares float that Google gave me for this example. So the average is around 22% based on the number that I created and the one that was given to us on highshortinterest.com. Now we can combine this metric with another metric, which is the short interest ratio, days to cover. In the first page that I showed you, the days to cover is showing 1.6, but based on the math that I did earlier, it's actually a little bit closer to 1.8. The way this works again, guys, is if you have 1,000 shares and there's around 100 shares being traded on average, that means the days to cover ratio is 10 because 1,000 shares divided by 100 shares traded, or the volume is 100, gives you a ratio of 10. The higher the ratio is and the more the stock price moves lower, essentially primes the market for a short squeeze. Now, the reason I say SENSEONICS is a prime target for a short squeeze is because the price has been moving down significantly over the past couple months. And remember that short sellers do make money, so the same way that if you're going long or if you're buying a stock and you like to play stop losses under obvious lows, short sellers are doing the same exact thing but on the opposite side of the spectrum. They want the price to go lower, so there's a chance they're putting stop losses above these highs. So the longer this downward pressure drags out and the more shares become short and the higher the days to cover ratio becomes, the more that short sellers will have to cover their position in order to maintain a healthy days to cover ratio of closer to 1 or lower. So the reason I have this box here is because this box was essentially a prime area to be buying SENSEONICS, and it actually did at some point, surprisingly enough. These levels were established by previous resistance and by previous support. So what is considered a high short interest ratio exactly? A cover ratio between 1 and 4 usually indicates strong positive sentiment. Now, in the case of SENSEONICS, we know that's not entirely true because we have a high short to float ratio in SENSEONICS. A cover ratio above 10 indicates extreme pessimism in the stock. Short interest as a percentage of float above 20% is extremely high. So how exactly do you trade a high short interest ratio? As with all metrics that we like to use when evaluating stocks, a high short interest ratio is subject to interpretation. If a stock has many short sellers, it may be because the company is not very profitable, the business model sucks, or management sucks. On the other hand, high short interest ratio may also be interpreted as a contrarian signal that the stock is actually a bargain. Let's say the company is developing a new product, but early reports suggest the product may be unsafe. As a result of this early report, or possibly news or rumors, it could be anything, short sellers have piled in, pushing the short interest as a percentage of float above 10%. And in SENSEONICS' case, it's actually around 24%. If later on the product is proven to be safe, there may be a sudden flood of buyers. But because the short interest is so high, a large number of short sellers may be forced to cover their positions. This can quickly push the stock price even higher, causing a strong rally. Why exactly? Because covering their positions means they're actually buying the stock. Because of the potential for sudden rallies in these stocks that have high short interest ratios, many seasoned options traders or traditional investors consider this metric to be a bullish indicator. So what I want the takeaway to be here is that if you are able to combine three things, which is a high short interest compared to float, a very high days to cover ratio, and a falling stock price, and the underlying company like SENSEONICS has a lot going for them, and in this case, there's a good chance that we have good news coming from the FDA, there is a very high probability of a short squeeze happening. Now, of course, I cannot guarantee a short squeeze, but I'm saying that if these three things do continue to go up and align with a short squeeze, the more likely it is going to happen. We have to go based on data, guys, so it's important that you guys do your research and actually pay attention to the numbers and not just hope for one. You have to see what exactly is converging for something like this to actually happen. And for a SENSEONICS short squeeze, I am very hopeful right now based on the numbers. So that's it for this video, guys. Thank you so much for watching and making it this far into the video. If you liked the video, make sure you guys go ahead and hit that like button. And while you're down there, go ahead and hit that big red subscribe button. And don't forget to hit the bell notification to get notified when I make videos just like this one. Thank you for watching, and I will see you in the next video.